Did you know that most governments are technically broke? The US alone owes over $34 trillion, yet somehow keeps spending. Here's the shocking truth about how it all works. In this video, I'll reveal the 3 ways governments actually get their money and why national debt isn't what you think it is. You'll learn the hidden formula economists use to determine if a country is really in trouble. And I'll show you why some debt might actually be good for the economy. But first, let me show you something fascinating about who governments actually owe money to. When you hear that America owes money to China, that's not the whole truth. In fact, that scary headline about foreign debt is missing about 70% of the story. Let's break down how government borrowing actually works. Unlike you and me, governments don't walk into a bank asking for a loan. Instead, they sell something called securities, basically special IOUs that increase in value over time. These securities come in different forms: Treasury bills, bonds, and notes. But here's the fascinating part. Most of these aren't bought by foreign countries at all. Think about your retirement account for a moment. If you have a 401k or pension fund, chances are you're actually one of the government's biggest lenders. That's right. The largest holders of government debt are pension funds, insurance companies, and individual investors right here at home. When you buy a savings bond or invest in a retirement fund that holds government securities, you're essentially becoming the government's bank. This completely changes how we should think about national debt. When people panic about owing money to other countries, they're missing the bigger picture. The government primarily owes money to its own citizens, who are making steady returns on their investments. It's more like a family lending arrangement than an international debt crisis. Imagine trying to run a household where 70% of your expenses are legally required and completely out of your control. That's exactly what governments face every single year. Government spending falls into 3 major categories, and understanding these is crucial to seeing why cutting spending isn't as simple as it sounds. First, there's mandatory spending, things the government is legally required to pay for. This includes Social Security, Medicare, and veterans benefits. Think of these like your mortgage or car payment. You can't just decide not to pay them. Then, there's discretionary spending, which covers everything from military defense to education and infrastructure. Even though it's called discretionary, most of these expenses are pretty crucial. You can't just stop funding the military or close all public schools. Finally, there's interest on the debt, which is like the minimum payment on a credit card. Ignore it, and everything gets much worse very quickly. Here's what's really shocking. In the US, mandatory spending alone takes up about 65% of the entire federal budget. Add in interest payments, and you're looking at almost 70% of spending that's essentially locked in before Congress even starts debating the budget. The reality is that governments have very little flexibility in their spending. Most of the budget is already spoken for through laws and obligations that can't be easily changed. This explains why even when politicians promise to cut spending, the national debt usually keeps growing. Want to know the actual formula economists use to determine if a country's debt is dangerous? It's not the total amount that matters. It's something far more interesting. Enter the debt-to-GDP ratio, the single most important number in understanding government debt. GDP, gross domestic product, represents the total value of everything a country produces in a year. The debt-to-GDP ratio tells us how much a country owes compared to how much it produces. Think of it like a mortgage. When a bank decides whether to give you a home loan, they don't just look at the total amount you want to borrow. They look at your annual income. Someone making $200,000 a year can safely borrow more than someone making $50,000. The same principle applies to countries. Here's where it gets fascinating. Most economists agree that the danger zone starts when debt exceeds 100% of GDP. If a country produces $2 trillion worth of goods and services annually, they shouldn't owe more than $2 trillion. But here's the twist. Some of the world's strongest economies regularly break this rule. Japan's debt-to-GDP ratio is over 260%, yet they maintain a stable economy. How? Because they have strong institutions, stable tax revenue, and high investor confidence. This reveals something crucial about government debt. The raw numbers matter less than a country's ability to manage and service its debt. It's not about how much you owe. It's about whether you can handle the payments and maintain investor confidence. Now, let me show you something that will completely change how you think about government debt. I've created what I call the Government Debt Investment Matrix. This is a framework that shows you exactly how to evaluate whether government debt is an opportunity or a threat. Most people don't realize that government debt can be one of the safest investments available. Let's break down the numbers. Over the past 100 years, US Treasury securities have never defaulted. Even during the Great Depression, World Wars, and the 2008 financial crisis, these investments paid out exactly as promised. Here's how you can use this to your advantage. Treasury securities come in different forms, each with its own risk-reward profile. I'll show you exactly how to evaluate them. Treasury bills, T-bills, short-term, lowest risk, perfect for emergency funds. Treasury notes, medium-term, balanced risk-reward treasury bonds, long-term, highest potential returns. The key is understanding how these fit into your personal financial strategy. For example, if you're worried about inflation, Treasury inflation-protected securities, TIPS, automatically adjust their value based on inflation rates. Now let's bring it all together. Remember how we started by asking how governments can keep spending while being technically broke? The answer lies in understanding three crucial truths about government debt. First, governments don't need to pay off all their debt. They just need to maintain it at manageable levels. Think of it like a business that always carries some debt to finance growth. The goal isn't to eliminate debt entirely, but to use it productively. Second, government debt actually plays a vital role in the global economy. Those treasury securities we talked about, they're the backbone of the global financial system, providing a safe haven for investors and a benchmark for other interest rates. Finally, and this is the most important part, government debt is sustainable as long as a country maintains economic growth and investor confidence. That's why the US can sustain higher debt levels than smaller economies. It's all about trust in the system and ability to generate future income. The real danger isn't debt itself, it's losing the confidence of investors. When that happens, interest rates spike, inflation can surge, and the cost of new borrowing skyrockets. That's why governments focus so much on maintaining stability and growth rather than eliminating debt entirely. Hit subscribe because next week, I'm breaking down how taxes actually work and revealing 3 surprising things that are taxed in ways you'd never expect. And remember, understanding how government debt works isn't just about economics. It's about making smart decisions with your own money.